Thanks for having me. This paper, I'm really excited to have it out. I've been struggling with this work I've tried to write this paper twice before in the last 10 years. The current version, which I'm very happy with, my co-authors are all at Dimensional, where I've been involved for quite a while. It's about reversals and the return to liquidity provision. These things are quite closely related, I think. There's this fact that we probably all know that if you look at short-term performance, 1 month out, of stocks that have gone up over the last month, they tend to underperform slightly those that have gone down over the last month. And it's fairly weak in the data. It's not very strong outside of microcaps, and it's gotten a lot weaker post-decimalization. So those are the reversals I'm talking about. They're related to liquidity provision, and I think there's a really nice paper of Stefan Nagel's from 2012 that talks about how you can think about these as the reversal performance as a proxy for liquidity provision. And the intuition, the way you should think about that, is that you go to the market demanding liquidity. You want to sell a stock. Well, there's someone who's going to come in and buy on the other side, and sometimes that person you're having to encourage to come in, they're providing that liquidity, and they expect to get compensated. And as you're selling the stock, they're partly being compensated by, as you take that liquidity out of the market with your selling, you're pushing prices down. The buyer of the stock who's providing that liquidity for you expects part of their compensation to come from the fact that though you've pushed prices down, as liquidity comes back to the market, prices are going to recover a little bit, and so they're going to be able to sell that stock on average at a slightly higher price than they bought from you. So that's the basic intuition. Nagel provides a picture kind of like this. The vertical line there shows the sample up to the end of Nagel's sample, and then on the right side it shows what's happened after that. But it's basically correlating the performance, the profitability of these reversal strategies with VIX, so with the level of market volatility, which we know volatility is correlated both in the time series and in the cross-section with the cost of trading. And so he provides this sort of strong time series evidence that reversals are more profitable when it's expensive to trade, and he links these things tries to directly link them into the reversals to liquidity provision. In terms of what I'm doing, I think of this paper as sort of being what are the cross-sectional implications of that idea that the profitability of reversals is related to liquidity provision. So Nagel provides evidence in the time series, but there's a lot of cross-sectional implications. It's not just about an aggregate phenomena. We think that if liquidity matters for the profitability of making markets, that we should see differences in reversals across strategies constructed using stocks with different liquidities. And this isn't going to be just about magnitudes. Stefan's paper is all about magnitudes. I have results about magnitudes as well, but I think that some of the most interesting results are really about persistence. How long do these reversals last? And I think that what we're going to see in the data actually relates strongly to some of Pete Kyle's work on microstructure and variance, and in particular on business time. Things just run at different rates. Calendar time might not be the appropriate way to look at how fast some of these liquidity phenomena occur. All right, so in general, when I write a paper, even when I read a paper, I'm always encouraging my students when they're working on papers to think about what is it people should remember your paper for. There's so many papers out there that if you ask someone about it, they'll tell you something, and it might not even be what the authors intended. But generally, we don't remember papers for whole papers. We remember them for one thing. And so I'm going to try and give you that up front. And this is what I think you should remember about the paper if you only remember one thing. Okay, so this is showing the performance of some reversal strategies. And I'll get to the details later, but sort of big picture, the performance of these reversal strategies. I'm showing winner minus loser spreads. So you really think of this as, you can think about this as negative momentum. That's why they're going down. Eventually, these would turn around. And I'm showing this for strategies constructed within stocks that are very different on some aspect of liquidity. And in particular, in the left panel, I'm showing you reversals among low and high volatility stocks. And on the right-hand panel, I'm showing you differences between low and high turnover stocks. Okay, so what you see on the left with the volatility is that there are massive differences in the performance or how big these reversals are across high and low volatility stocks really out for 1.5 to 2 weeks. Okay, so in these pictures, you can think about the portfolio as being formed at day 0, and then you're just holding it out over time. And I'm basically showing you 3 months of trading days after that. So what you see is in the first 2 weeks, the high volatility reversals are much bigger than the low volatility reversals, but there's some convergence after that. And on the right-hand side, it's very different. There it's by low and high turnover, and what you see is almost no difference in performance over the first, again, 1.5 or 2 weeks, but a very sharp divergence after that, with the reversal completely done after less than 2 weeks for the high turnover stocks. But for the low turnover stocks, the reversal actually persists out for 3 full months, which is a very long horizon relative to how we typically think about kind of reversal performance. All right, so I'm writing about trying to link these things to liquidity, and I've shown you volatility and turnover. Those are 2 of the big variables I'm going to use. I'm also going to be looking at size. Why do I choose these variables? Well, I think that just, by casual introspection, these should all be related to liquidity. Size, small stocks, we kind of all think of as less liquid. There's less attention and less market making there. High volatility, we know that volatility is correlated with the cost of trading, and so should be correlated with something having to do with liquidity provision and transaction costs. You can also think about it as driving inventory risk. If there are market makers who are taking positions in individual stocks and exposing themselves to large levels of risk that, even though it's idiosyncratic in the technical sense, they can't diversify away, how big the risk of the position isn't just how many dollars of the stock they hold, but it's related to how volatile the stock is. And then turnover should matter as well. Turnover, again, if we think about trading time or turnover business time, the stocks that trade less, things run slower. I tend to think about this in terms of inventory durations. It's harder to, if you develop a position making markets, it's harder for you to work that position off your books if there's less turnover for you to be working that. The other reason I've chosen these 3 variables really is, again, due to Pete Kyle. The simplest sort of empirical, easy implementations of the Kyle model, the thing that's most common in the literature is the Amihud measure, which is, it's not a fully satisfying estimation of the Kyle's lambda, but it's a pretty good approximation that's easily you can estimate it using very readily daily data on returns and volumes. And so it's very commonly used. And it turns out that these 3 variables explain on average 96% of the cross-sectional variation in the Amihud measure. And Pete's more recent work on microstructure and variance also has suggested an entire class of transaction cost estimators, which basically are based on these 3 same variables. All right, so the main facts that are going to come out of this analysis is that reversals are stronger in small stocks, but I think the kind of surprising thing is how concentrated this is in really in like the bottom 3% of the market by capitalization. They don't look dramatically different between mid caps and large caps. You do see stronger reversals in micro caps, but it's really among the very small stocks. We're going to see stronger reversals among high volatility stocks. That's true even after controlling for differences in pre-formation spreads. More volatile stocks tend to have more dramatic recent performance, but even controlling for the size of differences in the pre-formation spreads, past performance between winners and losers, you see that the reversals are bigger for the higher volatility stocks. And then I think the most striking feature of the paper is just how persistent the reversals are for the low turnover stocks. All right, so one other thing I'm going to do, and it's not really the point of the paper, but we are going to use a reversal refinement for a lot of our empirical tests. We're thinking about reversals as a lens to study liquidity, but sort of the literature basically suggests that the reversals come from price movements that are unrelated to news. Okay? And there's some obvious sources of news in past performance that we don't expect to get reversed that dramatically obscure how big these reversals are. In the data, the reversals look pretty weak, and especially in the last 20 years, but I think if you take out some of that news-related returns and prices, they just look dramatically stronger. So the obvious things are that news, when you buy a winner, or if you're going to trade a reversal and you buy a loser, the loser, we expect that the loss to be somewhat reversed the next month in expectation. But if it's a loser because it announced really poor earnings the last month, we don't expect that to get reversed. If it's a loser because the industry it's in is down, but it's outperformed its industry, we don't expect that to be reversed either. And so you can do sort of a decomposition where you take out the post-earnings announcement drift and the short-run industry momentum from reversals, and the reversals just look dramatically stronger. So here, the left-hand side of the first panel, Rev, is basically saying that the unconditional reversal strategy, buy the stocks that were down the most last month, sell the ones that were up the most last month, has on average earned 31 basis points per month over the last 50 years, so a few percent per year. It's not really highly statistically significant. This has come down in the last 20 years, so it's weakened these results. But if you adjust past performance for earnings announcements and for industry performance, you get the right-hand side. That IRX is industry relative reversals, excluding earnings announcement returns. And there you see a return of almost 110 basis points per month. And it's actually only got about half the volatility of a standard reversal strategy. And so it's got a Sharpe ratio that's roughly 6 times as high. And if you do a decomposition, regressing the returns of a standard reversal strategy onto these sort of what I think of as liquidity-driven reversals and industry momentum and post-earnings announcement drift, what you see is that the reversal is loading heavily on what I think of as liquidity-driven reversals, but it's taking very large short positions in post-earnings announcement drift and industry momentum. And those headwinds are really obscuring how big the reversals actually are. Okay. None of the results I'm showing you really depend on their choice of using these industry relative earnings announcement adjusted reversals, but it just gives you a better lens. The magnitudes are bigger, and it gives you a sort of cleaner results on how to look at these things. All right, so I've already shown you some of these pictures, but really a lot of what the paper is doing is forming portfolios and looking at how they perform over time. Again, we're going to be using size, volatility, and turnover as our sort of the differences we want in stocks when we're constructing these reversal strategies. And I'm going to show you results using different past performance windows. So a lot of the literature has looked at monthly past performance. Some looks at shorter stuff. I'm going to offer you reversal strategies based on stocks that are winners or losers over the previous 1 day, 1 week, or 1 month. There are advantages and disadvantages to each of these. So for me, the cleanest results in terms of what's going on come from only looking at 1 day of past performance. When you get out to 21 days, you get smoother results. The statistics are somewhat better. But I'm looking at phenomena where reversals sometimes only last 5 days. And so if you're using 21 days of look back to look at past performance on something that only lasts a week, it's really not very informative, and it gives you some misleading results. So using more time in past performance gives you kind of smoother results, but they're harder to interpret what's going on. Okay, so first, this is size. Here I'm looking within NYSE quintiles based on market capitalization. And the left is the 1 day, the right is the 21 days, the middle is 1 week. So what you see here is that there's a dramatic difference between the magnitude of these reversals between the smallest NYSE quintile, which is really only about 3% of the market, and the rest of the market. There's really not big differences in how big these reversals are outside of the real microcaps. A lot of this is driven by very big 1 day effects. 60 basis points at a 1 day horizon among these tiny stocks. When you look at volatility, I guess I'll focus on the middle here. It looks similar to the left, but a little more dramatic. You see this kind of clear increasing size of the short-term magnitude of these reversals as you go up the volatility quintiles. But there's some convergence after several months. Things start to get confusing when you get out to 21 days. This is why I'm reluctant to do the 21 days for these. It's because the cardinal ordering of where the reversals seem biggest switches when you get out to 21 days for volatility. And that's really because here I'm not controlling for correlations across the different liquidity variables I'm using. I'll control for those in a second. But here, it's hard to really interpret the right-hand panel because the high volatility stocks, which I think of as having the bigger reversals, we see that the green line in the middle panel, those high volatility stocks also tend to turn over more. And so even though the reversal, the magnitude of that reversal is big from what's happened recently, when you get out to long horizons, the fact that these stocks turn over more means the reversals are less persistent, and you're already starting to kind of, when you look back that far, you're not really getting a good reversal signal for the high volatility stocks because they tend to turn over quite a bit. And then finally, there's the turnover plots here. Again, I think the middle panel's the easiest to interpret here. You see basically across all 5 turnover quintiles, things look identical for a week and a half or 2 in trading time. But then you get these divergences in how persistent the reversals are, with the lower turnover stocks having more persistent reversals. And then here, the right-hand panel is very dramatic, and it's easier to interpret here. Here, I'm using a 21-day signal. Well, for the low turnover stocks where the reversals are very persistent, not only are they reversals persisting and lasting longer, but that past look-back period is more informative. The returns that happen 21 days out still predict reversals for the low turnover stocks, and so that increases the magnitudes there. Whereas for the high turnover stocks, what was happening the first half of the previous month is just noise in sort of predicting the reversal for the high turnover stocks, because there the signal is very transient, and so the reversals get very weak. Again, I said that really we need to be careful because we shouldn't be looking at these things sort of in a univariate sense when they're highly correlated. The small stocks tend to be more volatile, but they tend to trade less. The high volatility and high turnover stocks, those two things are positively correlated with each other. And so we have a bunch of tests which are a little more complicated that essentially attempt to control for 2 of the liquidity variables while getting dispersion in the third one before you construct your reversal strategies. And I'm not going to go through all this. I'm just going to give you one example of that. So this is showing you within a size universe. So we've controlled for size. We're looking at all the stocks of similar size. We're on the left picking stocks that have almost identical turnover, but have differences in volatility. So that left-hand panel is really trying to control, we've got the same size, the same turnover, but differences in volatility. How does that affect reversals? And what you see is that you have these big differences, again, really only over the first 2 weeks. And then once we've controlled for turnover, there aren't differences in persistence, and so you get this sort of parallel performance outside of that 2-week window where the volatility really matters. On the right-hand side, stocks of the same size, same volatilities, but differences in turnover. And there you see really, almost identical performance for the first couple weeks. But then you get this divergence with the reversals ending much sooner for the high turnover stocks and continuing for the lower turnover stocks. For me, as an academic, one of the really interesting things about these results was that there were a bunch of results in the literature, just sort of weird facts about reversals and momentum that were known that can be understood simply in the context of the results I'm presenting here. And a couple of those results are stuff that was in the literature because of me, and so I was particularly interested about those. One of them, which is obviously related to this work, comes from my co-author, Mamdouh Medhat. So he has this RFS from a couple years ago, basically documenting that even though we see unconditionally short-term reversals, that's the middle bar, the negative performance if you construct reversals using all stocks, the point of his paper was really that there were some stocks where you should not expect reversals, you should expect momentum. And it was the high turnover stocks. And I think that in the context of this and thinking about things in turnover or business time, it makes perfect sense. Here I'm showing you, the left-hand side of this is basically showing you the Manhattan-Schmeling result, but not in average performance over the next month, but in what happens from portfolio formation on average. So in that left-hand panel, we're choosing, we're forming reversal strategies on the basis of prior month's performance, and we're looking at what happens over time. And that vertical bar is the 1 month horizon at which they measure their performance. And they call the blue line momentum and the yellow line strong reversals. It's not really that there's no reversals, and that there's instantly momentum in these high turnover stocks. It's just that you're looking at a horizon, a 1 month past performance window is a very long time to look back for a high turnover stock. And measuring performance a month later is sort of a very long time to go forward to measure it, and you're already into the momentum region for those high turnover stocks, where for the low turnover stocks where the reversals are persistent, you see much stronger reversals. I have a sort of similar result from a transaction cost paper. There's just this very weird fact, or it seemed weird, that industry relative reversals, which are stronger than reversals, look much stronger among low volatility stocks. And these are all monthly strategies. This fact has been picked up on. It was, there's one of the early machine learning papers, this Kozak, Nagel, and Santosh, finds that this industry relative reversals constructed among low volatility stocks is the single most important component of a stochastic discount factor estimated by their machine learning techniques. There's some other people who have picked up on this. So I was interested in looking at that, and here, again, the left-hand panel here is showing that result. It's showing industry relative reversals based on a month of past performance from portfolio formation, and the blue line is the low volatility stocks, the red line is the high volatility stocks, and a month out, the low volatility reversals are much bigger than the high volatility reversals. But again, there's this correlation. The high volatility stocks tend to turn over more, and so they have much less persistent reversals. And if you go back to only a 1 week look-back signal, the right-hand panel there, you actually see much stronger industry relative reversals among the high volatility stocks than among the low volatility stocks. The problem is we were doing this simple thing of looking at monthly look-backs and monthly look-forwards. We weren't paying enough attention to the frequency with which these phenomena actually operate. And if you don't look at things at the right frequency, you can get very misleading results. There's also, kind of looking longer term, this has relations to some results about momentum. There are papers from 10 years ago documenting that momentum's stronger among high volatility stocks. I also have some work saying that if you want to look at big momentum performance, it's not based on what happened over the last 6 months, it's based on what happened over the 6 months before that. If you look longer horizon, so this is showing the performance of winner minus loser strategies based on just 1 month of past performance, but holding them out, fixing the portfolio and holding them out to a year. Okay, and what you see is among the high volatility stocks, the green there, that momentum sets in very quickly. The reversals ends quickly and the momentum sets in. For the very low volatility stocks, it's shocking, but momentum doesn't sort of kick in for 7 months. Okay, and this picture explains both the results. You see the high volatility stocks, they have stronger momentum because momentum kicks in immediately, whereas it takes a long time to set in for the low volatility stocks. If you're using past performance, well, when momentum doesn't set in for 6 months with some stocks, you should expect that the longer horizon past performance, the stuff from before 6 months ago, is going to matter more unconditionally. Okay, so this explains both those results in the literature. It also suggests a refinement, which we can easily test. If you look at this picture, where does it say that momentum should differ among sort of recent history and longer history? Well, if you look at this, it looks like momentum's relatively the same for the first 6 months or the next 6 months on the high volatility stocks, but it looks much stronger out 6 months for the low volatility stocks from the high volatility stocks. Okay, so the refinement says that my result on the differences in intermediate and recent horizon past performance should be concentrated in the low volatility stocks and should be largely absent from the high volatility stocks. And if you test that, that's exactly what you see in the data. So the low column there shows you that there's really no there's really no momentum. It's negative momentum. Reversals out to 6 months among the low volatility stocks. Huge differences in performance, long or intermediate and short horizon past performance there. But if you go out to the high volatility stocks, there's really no statistical difference in the strength of momentum based on intermediate and longer term past performance. I guess there are a couple other things I've been working on since the first version of this paper. One thing is we also have some results directly related to liquidity, fairly recent results, that basically argue that reversals are concentrated among recent losers because there's less liquidity provision among those stocks because they're stocks that institutional investors shy away from. So there's some evidence based on institutional holdings that among these loser stocks, there's less institutional holding, and we do see in the data that reversals are much stronger among these loser stocks. Okay. It turns out that the situation's more complicated than that because if you look at what's driving the weakness of reversals among the recent losers, it's not the component that I would identify with liquidity. It's really almost 100% driven by differences in the strength of post-earnings announcement drift, which tends to be very strong for winners and weak for losers. And so the reversals are facing this post-earnings announcement drift headwind among the winners much more than among the losers, which creates this big disparity in the strength of the reversals among stocks that performed well or poorly over the last quarter. And then one other thing that's not in the paper, but I'm working on including in the next revision, is sort of what does this mean more practically for people who are actually constructing portfolios? I mean, you could, in theory, try and trade this directly and be a liquidity provider, but I'm also interested in just how do we use these facts about liquidity to inform what we're doing anyways? So the way I think about this is if you're doing any portfolio management in your life, you are making decisions about when to buy and sell. And what are these signals I'm looking at really telling you? Well, they're telling you about when liquidity is expensive, when liquidity has been taken out of the market, and how long it takes to come back. So it can help inform practitioners about if they want to buy something, do they want to buy it right now, or does it look like liquidity is very expensive on that stock, liquidity has been taken out of the market. If you come and demand liquidity in that stock right now, it's going to be very expensive to trade, and you could expect very short-term poor performance if you're buying at that time. And so I've been thinking about how you use this information to inform not the trades you actually make, but the timing of the trades you make. Should I delay this? The stock has entered the buy range for me. Should I delay buying it a month? I want to hold it long term, but because of these liquidity concerns and how I can measure them based on past performance metrics, you might want to delay a stock you want to hold. Buying a stock you want to hold long term, delay buying it a month because for liquidity reasons, you expect it to have very poor performance over the very short term. You can use information about the characteristics of the stock to try and forecast how big these concerns are and how long they last. So that's work in progress. All right, so in terms of the conclusions, we see that liquidity, I think ex post, it shouldn't be that surprising. Less liquid stocks should cost more to trade, and if reversals are evidence of market maker profitability, we should expect small stocks to be more expensive. And the more volatile stocks to have these bigger reversals. And we also, again, the really dramatic thing I want you to remember is that these things last months and months in the low turnover stocks. I think there's interesting further research there because I don't believe that the actual proximate market makers it's taking 3 months for them to get inventory off their books when they have traded a stock. But I think the market making process is much more complicated than academics often think about. And I think that there's proximate market makers And then I think there's a whole range of different levels of market making where the market makers themselves sell to some secondary liquidity provider who might hold the stock for a month, but they're not going to hold it on their books a long time. And there's a whole kind of diffusion of the portfolio holdings that takes much longer horizon than what you see just looking at market maker inventory durations. And I think it's a really interesting place for further study. So thank you.
All right, so good morning, everyone. First, I would like to extend my gratitude to the organizers for such a wonderful opportunity to discuss Rob's paper. This paper delves into a pivotal question. The question is, what expected returns do investors anticipate to pay in the capital market? And for economists, it's definitely one of the central asset pricing questions. For investors, on the other hand, they definitely also value this question because they are very much concerned with the cost they're going to pay in order to gain liquidity or provide liquidity in the capital market. And the regulators, of course, they also think this question is a first-order important question because they believe the market liquidity or the liquidity provision in the capital market play a vital role in maintaining financial stability. So, however, recently, some may argue this question becomes less important. The reason is people think, given this kind of technological advancements, and they will enhance this kind of market liquidity. However, while technical advancements can enhance market liquidity, but actually the recent studies also found they can introduce new challenges for it. One example would be the recent work myself with Itai Goldstein and ENG. We show, if we have this kind of AI-powered trading, actually the market, we are seeing this kind of like a new challenge for market liquidity. They may compromise market liquidity. Additionally, actually emphasized by the ICEC chairman, Gary Gensler, he emphasized that such technologies actually can promote herding behaviors among individual investors, leading them, make similar trading decisions driven by the same strong signals they gain from using their technology. And given all this together, we believe the value of this liquidity provision and the level of market illiquidity remains significant in the capital market. So this question asked by this paper still is a very important question. So, however, to understand market liquidity is very tricky. Why that's the case, right? So Grossman and Miller in their 1988 paper provide a good summary of the concept of market liquidity. They said market liquidity is determined by both the demand and the supply of the immediacy in trading. So it's basically, it's like you can imagine the capital market, there's some like intangible valuable goods called immediacy in trading, and there's the supply side, there's the demand side. And the liquidity we say is like, equilibrium outcome of these both forces. And in Pete Carroll's 1985 paper, Pete also emphasized market liquidity is not a simple concept. Instead, it's rather complex. It is an abstract and a multidimensional concept. It is driven by numerous factors, from both supply and demand side of the trading immediacy. And pinning down it using just one number or one statistic is really tough. And fully embracing this, concept, this insight, this paper offers, study, try to argue the different assets, facets of the market liquidity may have distinct market prices. So to be more specific, the main objective of this paper is to estimate the expected returns from providing different types of liquidity. To achieve this goal, the authors take a two-step approach. Let me slow down a little bit. So first, the authors identify the component in short-term reversal due to the liquidity provision. It's called IRRX. by removing this kind of a post-earnings announcement drift and also this short-term industry momentum. Why? Because these two are like two prominent trading strategies. It's like based on this kind of news-driven drift. They want to remove this, to identify this liquidity-driven component in the short-term reversal. So it's a very neat idea. And once they construct this kind of liquidity-driven component, they further dissect this kind of liquidity-driven return reversal to identify their sources. In this paper, particularly, they focus on the inventory risk measured by stock return volatility and the inventory duration measured by stock turnover. So this is one of the main results of the paper. In panel A, it shows this kind of performance of 5 different trading strategies. So this REV, the first column, it is the standard short-term reversal. You can see the average monthly return, excess return, the magnitude and the significance, both are weak, right? So the second column is this trading strategy based on this post-earnings announcement drift, and the third one is based on industry momentum. Both are positive and significant. The idea of this paper is to remove the second column and third column from the first column. So they will reach to the fifth column, this IRRX. So that's what they call liquidity-driven reversal. You can see suddenly you compare the first column and the fifth column. The average return is much higher, both in magnitude and in significance. Okay, so then they in panel B, they kind of say whether this kind of decomposition is valid. In the sense, there's 3 components really statistically span the variation in the original standard reversal. They say yes. Actually, you can see the R squared is pretty high. It's close to 90%. So it's a very nice decomposition. Now they take this liquidity-driven reversal, and they kind of like further utilizing this cross-sectional variation. They look at the stocks who has high volatility and the stocks with low volatility. So to interpret this cross-sectional variation, they use this stock return volatility as a proxy for the inventory risk this market maker or this liquidity supplier must bear. Right? If this is inventory risk is higher, they require higher returns to provide this liquidity. So you can see the right curve representing the stocks with high volatility. You can see this reversal is faster and much more dramatic. And if you do some back of envelope calculation, you compare this kind of this kind of gap around 2 weeks between these two lines is about 0.6%. And based on this, you can calculate back out, what is this monthly excess return investors have to pay for this inventory risk, right? It's about 1.2% monthly. So it's very big. And the next result is they do another cross-sectional decomposition. So they look like this kind of stocks with high turnover and the stocks with low turnover. So this red curve represents the stocks with low turnover. So it's a very striking result when you first look at this because you really don't expect the reversal will be so persistent. But here is like fit into the story pretty well because due to this kind of this duration story, because for low turnover or longer duration, inventory duration stocks, there's the suppliers, they require higher compensation, right, for bear this kind of risk, providing this kind of liquidity. And at the same time, because it's longer duration, it's lower turnover, the news will be incorporated more slowly, right? So this can be seen actually if you write down dynamic kind of model, it's very clear. So it looks striking, but when you think about this, you appreciate the economics behind it. It's a very nice result. So my first comment is, I like this kind of liquidity-driven components in the reversal. The idea is to remove this kind of news-driven, drifts from this reversal. In this paper, the authors focus on two, right? There's a post-earning announcement drift and industry momentum. But my question is whether this tool will be enough to remove all the condemnations caused by this news-driven drifts. Because for the past decades, we see in the asset pricing literature that there are other cross-firm or cross-industry news-driven drifts. At a firm level, we know this famous paper by Cohen and Frazzini, right? Think about this cross-input-output links news-driven drift. And across the industry, it can go back to Harrison Hall and his co-authors, this kind of lead and lag industry drift. And my recent work with Wei Dou, my co-author, so we identify and show this cross-industry momentum via this competition, horizontal competition network. So I'm thinking whether, I would suggest the author think about also remove this component, see whether they can make the Sharpe ratio of this IRRX even higher. My second comment will be the identification of this inventory risk. I think it's definitely there, it's very important, but how can we better identify and estimate? This paper already made a huge progress on it, but I think to give better answer, we should be more careful about this causal inference. So because we all know, right, this return volatility, this is the measure this paper used to proxy this inventory risk, and the return reversal, both are highly endogenous. When you think about the association in the cross-section of two highly endogenous variables, you may think this association may not reflect the causal relation, which means the inventory risk caused the reversal. Actually, here there's a concern about this reversal causality, because when we thought in the cross-section according to stock volatility, maybe mechanically we put this kind of stocks who have short and quick return reversals into the decile and the groups of high volatility. So that's why you see this association in the cross-section. It doesn't really mean causal. So my suggestion is actually there are more data comes out about these quantities, about knowledge traders' behaviors. One measure I think the authors can use is the monthly standard deviation of the retail investors' order imbalances. This has been used by some researchers in the literature. And the idea is, this kind of inventory risk, yes, it's a volatility risk, but volatility risk of the returns, but there you want to focus on those really caused by this short-term knowledge trading, right? So basically this data on the retail investors' order imbalance can be useful for this to improve the result. And the last comment of mine would be, yes, go back to the definition of the market liquidity. Right, Kyle made a lot of contribution on this, and Grossman and Miller. So it is supply and demand. And this inventory risk and the inventory duration the factors considered in this paper, all focus on the supply side. So when you think about the variation, cross-over variation of the factors from the supply side and their impact, usually we need to think about whether we've been doing a good job to control for the demand side. So I know it's a very challenging question, but actually there are some advances in the literature for the past few years. Again, I want to go back to this data. This is retail investor order imbalance data. So maybe the authors can use this kind of retail investors' absolute monthly order imbalances as a proxy for the trading intensity of knowledge traders to control that and to think about the variation on the supply side, okay? And also there are some literature, they try to estimate the demand curve from the demand side of liquidity. And go to Koenji and Yogo in 2019 and some follow-up improvements. So basically the authors can also take out this kind of price impact of the demand shocks, liquidity shocks, right, from those papers and try to control for those and look at the variation on the supply side of the liquidity. So that will give a better estimation and a better identification. So let me summarize. First, this is a really great paper, a significant empirical contribution on this very important yet very challenging topic. What I appreciate the most is this paper provides a novel and a useful estimate of the expected returns from liquidity provision. And more importantly, they offer this very valuable perspective on the pricing of liquidity from various origins, various sources of liquidity. They just don't try to, put one number, say this is the return on this on market liquidity. They did a very careful job, fully embraced this kind of insights from theoretical literature, try to say this is the price, this is a return for this type of liquidity, this is a return for another type of liquidity. So I think this is a very promising direction to go. I have a few humble suggestions to further refine the metric for the liquidity provision component and sharpen the identification of the impact of inventory risk and explore the factors influencing this kind of liquidity from the supply side. From the demand side, and the control for them when you think about variation from the supply side. That's my discussion. Thank you very much. Thank you.
Rob, do you want to react, and then we'll open it up for
Sure.
questions?
So, there's a couple issues. One is I think Winston is correct about some of the issues, but the struggle writing a paper is never to kind of put more in and do everything. It's what you leave out and what's important. And I would actually like to take more out of this paper, not put more in at this point. And it's not meant, I'm trying to document, I think, some really interesting facts that aren't well known. And I think trying to do everything should be done, but maybe not in this paper, maybe in follow-on papers. In terms of, it's also not a theory paper. I do motivate some stuff with theory, but this is really an empirical paper documenting some facts. I guess those are the main comments. I think that doing a greater reversal refinement might be good, but it's, I don't think that's really, I think it's an interesting fact that you can so easily get a much stronger version of reversals, but it's really not the point of the paper. The paper is really about what different aspects, what other characteristics predict the size and persistence of these things. I guess the one question I had is about if it's really all supply side, because turnover is one of the big things we're looking at, and turnover seems like a demand side variable to me because the market makers are not the ones, we're only counting the trades as they're initiated, which is by noise traders or liquidity demanders, and that doesn't seem like a supply side variable as much to me.
Yeah. Okay. I agree. So, but my interpretation here, this kind of like an additional expected return due to this kind of inventory duration is more from the risk-bearing perspective of the suppliers. That's why I say it's a supply side.
Okay.
Yeah, they have to hold longer. Yeah.
Okay, let's open it up for questions. Questions in the front, Larry?
So the question is, are these results obtained from closing prices or closing spread midpoints?
These are closing prices.
All right. So for highly illiquid stocks, the spreads can be pretty large. And if a stock closes up, it's more likely to be included in those stocks that are liable to reverse. And of course, if they close down later, they're going to reverse. So if you would look at closing spread midpoints, you'll at least get some of what's happening in the first part of the sample, or the first part of these graphs.
Yeah, so that's a great suggestion. We should definitely look at that. Yeah. You're basically saying there's some bid-ask bounce in here that's not real in terms of...
So the suggestion, I guess the question is suggestion, so the other suggestion is that there are two possibilities for explaining these results. One is that it's a liquidity issue that we think is pushing on somebody's inventory, not necessarily the market makers, but somebody. And the other possibility is that people are responding in systematic ways to information, and it's somehow correlated, and they forget about things, and the pressure relaxes or something like that. Perhaps the way to discriminate between those two would be to see if there's any evidence that people are accumulating or divesting in the period during which we're identifying the stocks that are going to go into these portfolios. And we could do that by looking at transaction data, classifying them by whether the trades are taking place at bids or offers, and accumulating essentially what's called TRIN. And so that information might allow us to discriminate among these two possibilities and perhaps give us a deeper understanding of whether it's really liquidity or whether it's some other behavioral issue.
Yeah, so in the appendix, I do have some plots showing what happens, cumulative order flows in the periods leading up to portfolio formation, and it does look like there's some buildup of inventories in the way that would agree with. But it's, you know, those, you know better than me. It's based on Lee and Reddy algorithm in the TAC data, and I'm just not I mean, there's a lot of noise in that signing of the order flow as well. So, yeah, but it is there.
Thanks, Larry. Questions?
Pete has
Pete?
a question.
Yes. So if you're an asset manager and you're looking for a way to make money by providing liquidity, you know, this paper is obviously very interesting. But I wanted to suggest a story, and you tell me if you agree with it, which is that it's relatively straightforward to implement a strategy that just trades against one-day reversals or, you know, one-month reversals. It's also a little less straightforward, but it's quite not too hard to implement a strategy of trading on post-earnings announcement drift. But the gist of the paper is that those two strategies kind of undermine one another, and therefore the better strategy is to combine the two together. Technology has changed and data availability has changed in such a way that combining the two together is much more feasible now than it would have been, say, 20, 30, 40 years ago. So the time trends must be showing that it's dramatically less popular in recent years than in past years. That's my question.
I mean, we do show kind of trends and things, and we do a whole separate analysis post-decimalization versus pre-decimalization. And post-decimalization, like, the reversals are gone, but the IRX is still significantly profitable, though maybe only half the Sharpe ratio that it had in the early sample. But it's still a very significant thing in the last 20 years. You have less statistical power because you're looking at a relatively short sample, but there's no question that, I mean, I guess the way I think about it is that it's gotten cheaper to trade. And it's, you know, I use post-decimalization to include other things Winston mentioned, like direct market access and programmatic trading. And but I think there's no question the markets have gotten more liquid, and liquidity provision strategies, at least, none of these liquidity provision strategies, like, you could not, I would not say you could try capture all of this. Even if you're providing liquidity, there's some costs to you to doing that, and you're making these liquidity provision returns net of the costs you incur. And they're not nearly as profitable in practice as the very, very high numbers I saw. And so I think it's not surprising that as it becomes cheaper and you're incurring less of those additional costs, the gross returns to liquidity provision have come down as the costs to providing, that you incur providing it, have gone down as well.
Question in the middle?
Great paper. Definitely very intrigued by the IRX measure you have, and you sort of drew the contrast between high vol, low vol. I'm just wondering if you could tie that into cross-sectional dispersion. Like, you know, I mean, we know that overall reversal phenomenon depends on cross-sectional dispersion as well. So presumably that would exacerbate
Yeah,
the
so
IRX.
I haven't done this in this version of the paper, but I have a table in the revision I'm working on, which explicitly tries to control for what I would call pre-formation spreads. So there's a critique of these sort of conditioning variables on momentum in the literature, which is we see stronger momentum among high volatility stocks, we see stronger momentum among small stocks, but those stocks are more volatile, and so when you look at the amount of momentum in the momentum strategy constructed among high volatility stocks, it's much higher because the winners were bigger winners and the losers were bigger losers on average among those high volatility stocks. So I have a table in the paper now, or in the next version that will be coming out, that explicitly controls for pre-formation spreads. So among stocks of different volatilities, low volatility, high volatility, you're looking at strategies that have, on average, the same amount of spread in that reversal signal, and you still see these dramatic differences in post-formation performance. And so while the critique has been made for momentum, it doesn't seem to apply here. I'm not sure that's exactly the question you answered, that you asked, but that was what I interpreted it as being related to.
I meant that, you know, overall levels of cross-sectional vol determine the efficacy of reversals in general. So if you made it regime dependent, let's say you take the IRX measure and you make that regime dependent.
You're asking about some interaction between the time series results and the cross-sectional
Exactly,
results.
cross-sectional versus time series.
I have not done that. I hadn't even thought to do that, but I could look and how these results are different in different volatility regimes for kind of aggregate market. And I haven't done that. I could do that.
Questions? Right over here.
Have you thought about using the trading volume on the day of the big price reaction to kind of proxy out information or as a proxy for new information?
No, I mean, I'm using momentum as I'm using that trading volume really over the previous quarter. We've looked at different horizons, but the previous quarter is the primary version I'm using. I haven't looked for spikes in trading, though, and those are often also coincident with these earnings announcement days or windows that we are controlling for on the return side, but I have not explicitly used those as sort of a forecasting variable of how these strategies are going to do. We do know that concurrently high volumes associated on average with high returns, but I haven't looked at it here explicitly.
As a method for decomposing information, yeah. Ken.
Hi, thank you for the talk. I have a quick question for Winston. You seem to equate retail traders with noise traders in your suggestions. Given the fact that institutions, on average, also don't outperform the market, is that a distinction that matters?
So basically, in reality, noise traders, not just retail traders. Definitely, there are some liquidity traders, can be insurance companies, those type of firms. But here, I think the retail their trading behavior can be used as one of as an instrument variable to kind of like instrument this kind of like this supply demand side movements. So that's my suggestion. You should think that as an instrument rather than representation of the whole noise trade.